A real estate project developed as per joint development agreement is different from other normal transactions of purchase and sale of goods. So the tax implications also differ. But don't worry, by the end of this video, you'll be crystal clear on the specific tax implications that you need to be mindful of. Hello and welcome, I'm Maheshri from Clear, where we have assisted more than 80,000 tax experts and 6 million tax filers. Do subscribe to support us and to get a clear explanation of finance concepts. So let's start with what is a joint development agreement, that is JDA. Joint development agreements are very common in the real estate sector in India. In this arrangement, the landlord would provide the land and the entire responsibility of carrying out the development of the property will lie with the developers. The landlord can either ask for a specific share in the sales revenue under what is known as a revenue sharing joint development agreement or claim a certain portion of the developed area under an area sharing joint development agreement. This will depend on the terms and conditions in the JDA. The income arising to the developer under a JDA in the form of sale consideration of his share in the developed estate is considered as his business income and is taxed as per the applicable provisions. Under the existing provisions of Section 45, capital gain is chargeable to tax in the year in which the transfer takes place except in certain cases. The definition of transfer inter alia includes any arrangement or transaction where any rights are handed over in execution of part performance of contract even though the legal right has not been transferred. In such a case, execution of joint development agreement between the owner of immovable property and the developer triggers the capital gain tax liability in the hands of the owner in the year in which the possession of immovable property is handed over to the developer for development of a project. With the view to minimize the genuine hardship which the owner of the land may face in paying capital gains, it is proposed to insert a new subsection 5A in Section 45. The new subsection 5A in Section 45 of the IT Act overrides the provisions of Section 45(1). This provision is applicable only for individual and HUF landowners. As per the said provision, the capital gain arises to the SSE being an individual or HUF on the transfer of title of land by the landowner to the developer under joint development agreement. The capital gain shall be chargeable to income tax in the year in which the certificate of completion for the whole or part of the project is issued by the authority empowered to approve the building plan. However, if the SSE transfers his share in the project on or before the date of issue of the said certificate, then the capital gains tax shall be payable in the previous year in which such transfer takes place. For the purpose of Section 48, the stamp duty value, that is SDV, of his share on the date of issue of the said certificate as increased by the consideration received in cash if any shall be deemed to be full value of consideration. The said section is applicable only where a registered agreement or deed is executed and the date of execution of such agreement is on or after 1/4/2017. Mr. A purchased a residential plot on 1/1/1996 for 53 lakhs. FMV of plot as on 1/4/2001 is 65 lakhs. Purab Builders enter into a development agreement with Mr. A on 1/7/2017 on the following terms and conditions. Mr. A handed over the possession of the plot to Purab Builders on 1/7/2017 and in return Purab Builders pay a check of 60 lakh to Mr. A on 1/7/2017. As per the agreement, Purab Builders will construct 10 residential units on the plot of land and will give 6 units to Mr. A. The 12 units will be completed by 30/6/2020 and on that date, 6 units will be handed over to Mr. A. The stamp duty value of plot as on 1/7/2017 is 2 crore. The stamp duty value of each flat on 30/6/2020 is 40 lakhs. The project completion certificate is issued by the authority and 6 units are handed over to Mr. A on 30/6/2020. I hope you are with me so far. Comment clear if you have understood this, else leave your questions and we'll be sure to address them. Now let's discuss how capital gains should be calculated. As per the normal provisions of the Income Tax Act, there is a transfer on 1/7/2017 in the hands of Mr. X since he has given possession of residential plot pursuant to development agreement. However, section 45(5)(a) will be applicable since the assessee is an individual. Therefore, as per section 45(5)(a) introduced by Finance Act 2017, the capital gain shall not be taxable in the financial year 2017-18 but shall be taxable in the financial year in which the certificate of completion is received from competent authority, that is FY 2020-21. Sale consideration is equal to stamp duty value on the date of issue of completion certificate of his share, that is 30/6/2020 plus consideration received in cash. As per section 55, the cost of acquisition of plot is 53 lakh or FMV as on 1/4/2001, that is 65 lakh, whichever is higher. Therefore, cost of acquisition of plot is 65 lakhs. Do remember, the holding period of residential plot shall be taken from 1/1/1996 to 30/6/2017 and not up to 30/6/2020. Hence, it is a long-term holding period. The long-term capital gain in this example is rupees 1.23 crore. If in the given example, if the project completion certificate is issued by the authority on 30/4/2021, 6 units are handed over to Mr. A on 30/4/2021 and the date the stamp duty value of each flat is 55 lakh. Then the capital gains tax would be payable in the financial year 2021-22, where the sale consideration would be calculated based on the stamp duty value as on 30/4/2021. As per section 194 IC, if under a joint development agreement any developer pays an amount to the landowner in addition to the share in the project, such developer shall deduct TDS at 10% on such payment. So folks, this was all about tax implications if you enter into a joint development agreement. I hope this was helpful. Thank you for watching this video. Do subscribe to support us and to get a clear explanation of financial concepts. Stay tuned for more updates. Take care and goodbye.